Talk to us about some of the trends that you're seeing within the market, and what are investors focused on? What are investors excited about these days?
Let's talk about three asset classes, I guess. And then the fourth one I could give you is a couple of the trends that investors and their advisors are looking to take advantage of. So first and foremost would be, we're seeing volatility in markets. We're seeing a presidential change, right? There is a new regime, for lack of a better word, that is coming into office. And with that, there's the anticipation that there's going to be continued volatility, right? Whether it's deregulation that starts to take place, whether interest rates start to come down, depending on what the Fed does. But that's from us having conversations with managers. Those are some of their expectations, and as a result, we're seeing geopolitical market rattling, and we are seeing volatility. And so hedge funds, as a generalization, are a highly sought after asset class, because more and more, if you look at what advisors are trying to create for clients, is an evolution of this traditional 60-40, right? No one is trying to throw the baby out with the bathwater, but it's quite possible that nowadays it's somewhere like 40% to your public equity, 30% to your traditional fixed, and then 30% are in alternatives. And that's a topic that we tend to discuss a lot with advisors. The problem is, how do you carve out that 30% to alts and some of the other barriers to entry that we talked about? Because the reality is that 30% for a client who's working with an advisor is really a few $1 million. And it's not tens of million or hundreds of million, which is what the typical institutional allocator can work with. So now this is one way Bristol can help to bring hedge funds into a client's portfolio. And that really happens to be one of the parts that will bring risk mitigation to a client portfolio. And that's how advisors are looking at it. I think the second asset class, if we want to call it that, would really be around private credit. And again, as we touched on the outset of the podcast, looking at things from a 30,000 foot view, that second element, if an investor is looking for income and they want to do it at a premium to traditional, and the data is there, we work with handfuls of managers that have at any point in time, whether it's zero interest rate environments, rising rate environments, but over the last 2 decades, have continued to deliver 500-600 basis points premium to risk-free, if not more, and to do it with very low, if not no default rates, which ultimately becomes the enemy to yield. The third element is growth equity, right? We talked about also at the outset, a shrinking public equity universe. So when investors are genuinely looking at growth, we start to see growth equity as a real option. These are companies that already have product lines, already have teams in place, but are looking to scale businesses. And as a result, they need flex capital to continue to grow, and ultimately navigate from an investor standpoint for their needs for liquidity, either toward a public exit or to a corporate acquisition, which both right now obviously have not been happening in droves, but is one of the anticipations that, again, with a change in regulations, a change in market policy, a change in rates, potentially coming down, then those activities will obviously tick back up. So I think those three are important elements from an asset class standpoint.